welcome Financial Planning World. Dan Davis, co-founder. As you know, we run series on a variety of different best practices. Today, we're focused on the investment planning process. And the key theme is around alternative investments. My experience with alternative investments has been very mixed. If you go back to like the 1990s, late 90s, when I started using private REITs, public REITs, managed futures, I had almost immediate success with the public REITs, but we all know how that turned out over the following decade and a half. Not so good, to the point where I now only will do private REITs if there's some kind of a distress scenario where we're buying good quality in total distress. Public REITs have been very mixed. We still use them for our lower level risk clients that desire more competition or desire more diversification, as well as the ability to really be in a position where they're looking for yield and whatnot. Managed futures is the one we're really focusing in on today, because I was super excited in, say, 2000, 2001, when our managed futures was just extraordinary. But then we had a long period of time that we didn't get anything from them. We helped the clients and shepherd them through that. But in the end, we got a couple more good years, and call it 2009, 2018, 2019, everyone just finally gave up, to the point where we quit using managed futures altogether. I continued to do research on that because I really believed in the concept. And I'm happy to tell you that I found a group, Standpoint, and now their managed futures is back in our model. And I wanted to introduce them to you, our community, to learn more about how they're different, and you'll see why we're using them. And so today I'm joined by Matt Kaplan, Head of Sales, Eric Crittenden, Chief Investment Officer and Portfolio Manager. Matt, why don't you tell the crew a little bit about Standpoint?
Yeah, thanks for having us on, Dan. So yeah, I'm Matt. My role is Head of Sales here. I work with the advisors that are invested in the fund, introduce the concept to them and see if there's a fit. And Dan, you pointed out the struggle with alternatives, and that's not a very unique situation where we've seen advisors, that they find a concept that's interesting to them, they allocate to it, and then, maybe it goes through 6 months, 9 months, 12 months of underperformance, and clients become fickle. Why did we do this? And it kind of turns into this trap where you want to do something different, you want to allocate a piece of the portfolio somewhere else, but it's really difficult to find something and stick with it. So we took our experiences and built a product that we believe gives people the ability to diversify away from stocks and bonds, but also package it where it can be valuable during times where you want to be doing something different. And that's the concept of Standpoint. So we just crossed, we're about 3.5 years old, sitting at $600 million. We're relatively new to LPL, so we're happy to be introduced to the community.
I was very impressed when I saw the way that you guys package your products, and how when I lifted up the hood, how it truly was different than managed futures products that we've used in the past. Number one was just the liquidity feature, because a lot of the managed futures products we had used were only like quarterly liquid or monthly liquid, and then it required a signature, and candidly, it was a real pain. And I think having the daily liquidity is a feature that was interesting. It wasn't the reason why I really selected your team and made an allocation where all of our models have at least 5% of your product in our management for our clients. Eric, why don't you tell us a little bit about how you guys differ from other managed futures that you've been part of, or that you've seen, that you've studied, et cetera?
Sure. My name's Eric Crittenden. I'm the Chief Investment Officer here at Standpoint. And thanks for having us on, Dan. How are we different? Well, under the hood, we're not that different. We're trying to run a high quality, durable managed futures program to source diversification around the world in lots of different sectors and asset classes, things like metals and grains and currencies and energy markets, things that are fundamentally different from what's already in traditional portfolios. What we do that's different is how we package the product together. So we built what we believe to be a versatile and durable managed futures program, but we combine it with global equities and treasury bills in a way that is designed to deliver something more like an all-weather or a multi-strategy or a multi-asset global fund experience. And the reason for that, and Matt alluded to this a little bit before, managed futures on a standalone basis is very challenging. People tend to buy when it's going up and sell when it's going down, and don't get the best results when they do that. By packaging it the way we have, by mixing this global diversification with risk assets like equities and risk off assets like treasuries, we get that kind of all-weather experience. So I would say that that's the biggest difference between us and other managed futures managers, is that we empathize and understand the challenges that financial advisors and everyday investors face, and we try to package something up that has good risk-adjusted returns, but that they can also hold on to for the long term.
I have to say that was the reason why we decided to allocate towards your fund. And to me, the key difference was, in the past, I had managed futures that were having a sliver doing managed futures, and then the rest of the money was really parked in treasuries. And so you'd get these big pops when some chaos happened and you had large trends. But when that wasn't happening, you just had this severe underperformance that went on. And people literally, when the proverbial what was hitting the fan, maybe we had 5 to 20% allocation in managed futures, but the other 95 to 80% was getting kind of spanked. And so they didn't really see the managed futures. We did, because it helped the downdraft. But they're in the period where it's the only thing not making money, or it's making 2 or 3% and everything else is double digits. It's really hard to keep them in it. And so the way you guys package it with the global equities, I think, is quite brilliant. And it's one of 3 main reasons why we chose to work with you guys. Could you elaborate a little bit more on that?
Sure. I would say for the past 50 years, managed futures has been the best diversifier available. Bonds are very effective in a declining interest rate environment, but managed futures have, in my experience, been able to stand up and deliver when you need it most, both during deflation and during inflation. But like you just explained, it's very difficult for people to hold on to managed futures when they're not working. They look and feel to people more like an insurance product, where it pays off when you need it the most, but the rest of the time you kind of resent having it in the portfolio. So, but when we're running it internally, we're able to use the same pool of capital to finance all of our investments. So that we don't have to suffer a terrible opportunity cost the way an end user would have to. They have to choose whether to have managed futures or not. And that requires capital. And that capital has to come from somewhere, and usually at the expense of some other risk asset, whether it's REITs, stocks, the 10-year treasury, corporate bonds, whatever. And that becomes a very difficult decision that encourages people to try to time their allocations, and that just doesn't work very well for most people. What we're able to do is internally make our asset allocation decisions and have managed futures and equities and bonds in there all the time, to always have that diversification there and offer it as one product that has a much smoother ride and lower volatility and smaller drawdowns than risk assets through a full market cycle. So people look at it and say, well, it's kind of boring, but it seems to be effective, and it doesn't give me heartburn or cause a lot of fear and greed along the way.
Agreed. Another reason that I really liked what you do is you're able to build and exit positions in a space that I really can't do as a retail advisor, especially on the downside protection. So speak to the managed futures piece, and then how you build the position and how you protect it.
Yeah, so the first lesson you learn in this space is to control losses and to keep them small and never let them snowball into something that causes a problem. So your listeners have probably heard of concepts like a sell discipline or a stop loss or something like that. That's the very first thing you have to take care of when you're building a global managed futures program, is some set of rules that you follow religiously, that you never deviate from, where you can expunge or liquidate, get out of a position that's not working very well, and keep those losses small. That's essential. So as you mentioned, we have a rules-based process that we follow that's been rigorously tested over 50 years of data, that we ascribe to and follow. I've been in the business 26 years now. I've never not honored a systematic approach that we've had in place that has served me very well. And I can tell you that from experience is discretionary decisions are very difficult. If we think back to right before COVID, during COVID, 2022, when stocks and bonds declined, and I can go back to 2008, 2002, even the crash of 87, those decisions before the volatility goes up, the decisions before the risk is holding your feet to the fire, are very difficult on a discretionary basis. But a systematic rules-based process, it's very easy to stick with that. And that will give you the ability to make those decisions in a calm, structured, repeatable way. So you mentioned, how do we get into a position? How do we get out? Well, we use 3 different models to evaluate the strength of a market. Let's say we're looking at copper. We use a short-term system, a medium-term system, and a long-term system to measure the strength of copper. The short-term system is something like 6 months. It looks at 6 months worth of data and evaluates whether copper is strengthening. It looks at the term structure, the returns, the liquidity, and essentially says you shouldn't own copper unless it's strong, unless it's doing something, unless it's signaling to you that there's some sort of a bull market, supply-demand mismatch, anything that's leading to buying pressure. So we'll first get a signal in this 6-month system, and we'll put a small position on, maybe 1/3 of our total position size that's possible. If it continues to go higher and continues to strengthen, well, then the 9-month system eventually will kick in, and you'll buy some more copper. And if it continues beyond that, the 12-month system will kick in, and you'll have your full position on a copper. So you have some diversity of entry in that a market has to initially get strong, but then it has to strengthen beyond that and then further beyond that for you to really commit to a market. Now, that's just on the buy side. Once you have a position on, the size of that position has to be calibrated to the portfolio. So we want to regulate the amount of risk that we have in any one position and at the total portfolio level. So that's all embedded in the rules. And we look at the liquidity of the underlying market and its level of diversification relative to the other markets. And say we have a full position on in copper and it's sized appropriately. Eventually, copper is not going to work for us. It might reverse on us right away. It might go into a 2-year bull market and then it reverses. But we have to have a mechanism for getting out of copper or any other market that we're in. So like we had a 3-step process for getting in, we have a 3-step process for getting out. So we have something called a trailing stop loss or sell discipline. And it's statistically derived and it's designed to give copper enough room. We don't want to be trading frequently. I don't like trading frequently. But it has to be close enough to essentially get you out of a position before it turns into a bear market and you're on the wrong side of this thing. So sounds like there's a lot going on, but it's actually very simple. It's just one system, but with 3 different variants to increase the diversification, spread your risk as you're entering, control your risk during the trade, and then spread your risk out as you're exiting, and really diversify globally across 5 or 6 different sectors around the globe.
And because of all that, when we have our allocation towards Standpoint, we realize it is a true diversifier. It's not like I have growth, U.S. value, and I'm getting some diversification because of that component. So for you out in the financial planning world community that have given up on alts or using alts, whatever your stance is, I would highly recommend that you reach out to Matt and just schedule a conversation with him. In doing that, I did the first call. We probably have had 3 or 4 calls, and as a result of that, we've allocated 5%, as I said, to every part of the portfolio. Matt, if they're trying to reach you to get an appointment scheduled, how would that work?
Yeah, the best way to reach me is at Matt, M-A-T-T, at standpointfunds.com. We'll also put a little slide in that will have our contact information. You can touch base with me. And I'm always available, and we'll set up a call and talk.
Excellent. So on that behalf, as I end with all financial planning world best practices, you and our community know that the reason I'm doing this is after 35 years, I realize there is no best practices in our industry, which candidly is laughable. So if you have some areas that are best practices, you go on our website, financialplanningworld.com. You can reach out to me through there. I'd love to hear about it. and share it with the rest of the community. But I'd say one marching order is reach out to Matt, talk to him, learn more about Standpoint. You can then decide if it works. I've chatted with Eric quite a bit, and it takes a lot to impress me, and I've been very impressed. So thanks for your time, and good luck. Have a great day.